Fitness Profit. What's up, guys? We are back. Fitness Profit Multiplier. Anthony and Jimmy. Well, Jimmy's not here today. So I got on here. It's Anthony and Matt today. So I got Matt from Gym Lawyers back on. He's in his fancy library here for those of you watching on YouTube. But guys, today we're going to be talking about partnerships. A lot of you guys have partners in your gym business. So I brought the lawyer on here to talk about the correct way to structure a partnership deal and maybe some things that we could talk about. Again, I don't know if this is even possible, but if you are already in a partnership and you hear some of these things, maybe some of these, your agreements can get amended. Because sometimes I just feel like gym owners, especially, that maybe they're friends they start out with initially and say, hey, let's open up a gym together. They shake hands and they go and do it. So there's some legalities that we want to talk about to make sure that you're protected. Again, one of the biggest things that we talk about all the time is, giving you guys more profit and putting more money back in your pockets. And the way that you do that is with protection. And in this case, with partnerships, it's all about protecting yourself from your partner. As scary as that sounds, but that's generally how it works. But let's get into it. Let's talk about, let's start with corporate structure, Matt. So if someone wants they shake hands, let's open up a gym together. What's the first thing that they do?
Yeah. What's up, Anthony? Always a pleasure to be back on the show. Thanks for having me back. Just a quick aside, everything we're going to talk about is going to be talked about on a general matter. None of this can be legal advice, and every situation is always different. So anybody with specific questions, feel free to reach out, and we'll talk about that at the end, of course. But, just got to throw that disclaimer out here in the beginning.
We're just guys on YouTube.
Yeah. Just influencing the YouTube. No, look. So we're talking about partnerships, and first and foremost, as you just said, we've got to pick the first thing we got to do is talk about corporate structure. So partnerships, whenever somebody says partnerships, even to this day, I always think, like two guys or two gals or two people, right? And that's not necessarily true when we're talking about partnerships for a business. So we have a solo run organization, or LLC. You, Anthony, you've got a solely run organization, a corporation. I have a solely run LLC. But once we start adding more people, now they become partnerships. So that could be 2 people, 3 people, 4 people, 5 people, 20 people. Okay. Now all of a sudden we can just refer to them generally as partnerships. So what do we want to do as far as corporate structure is concerned? There's a whole list of different types of corporate structure we could get into, everything from general partnerships and limited liability partnerships and limited partnerships and all of those. I'm just going to kind of slide those things off to the side because not super important and not going to get to the primary goal of why we're setting up this corporate structure to begin with. And that goal is to protect our personal assets. Okay, so with that in mind, we kind of narrow it down to 2. There's corporations and there's LLCs, or limited liability companies. Okay. Generally speaking, for the gym owner realm, these small businesses, these little micro gyms, boutique fitness clubs, we don't want to worry about corporations because they're just too formal. I know you've got a corporation, Anthony, it's no big deal because you're sort of a solo owner, but when we start getting multiple owners in there, then we got to start talking about officers and boards of directors and making sure that we're tracking the books and paying everybody appropriately and issuing shares, and it just gets complicated. All right, and it's very complicated for what we're trying to ultimately accomplish. So in that realm, 99% of the time, we're just going to suggest a limited liability company.
So if let's just say I wanted to take on a partner, I guess this could be a scenario that would happen, right? So I'm doing well, whatever, I'm not doing well, and somebody comes along and says, hey, I want to invest in your corporation, Anthony. So how would I have to restructure my company and then go into an LLC?
No, I mean, you can do it as a corporation. One of the things that we would have to double check, in your instance is going to New York and seeing if you have listed a number of shares online. And, this is going to be very, very specific, state specific, changing from state to state. But generally speaking, when a sole individual opens up a corporation, they don't issue stock. There's no point. There's no reason to. You're the sole owner. You own all the stock. You own the 100% of one share of stock. Once we start to bring in partners, well, now we have to divvy up that stock based on their ownership percentage. So now we may have to go through a process by which we tell the state, this is now going to be a multi-stock corporation, and we then have to file paperwork to show, who owns what percent, et cetera, et cetera. So there's a process by which you can go through. You don't have to switch to an LLC. It's just a more complicated and formal process.
Okay, cool. So that's typically the corporate structure that people want to start out with, if they can. If your guys just shook hands and you guys are not official, go and start an LLC, call Matt, get all that set up, and then you can go from there. Then you can start taking business. So now once you start taking business, what's the first thing that you need to kind of have ironed out?
Yeah. So once we've got that LLC and we've got multiple people, then, well, even with a sole individual, we need an operating agreement. And sometimes this is referred to as a partnership agreement. Again, we're just sort of mixing words. A partnership agreement and an LLC operating agreement is the exact same thing. And just anybody listening who's moving forward with a corporation and saying, well, I still want to be included in the conversation, you've got bylaws. So, these are just written governing documents for your corporate setup. And so anytime we've got a partnership, and again, we're just going to kind of walk down that track of the LLC because it's the easiest one. We have the operating agreement, and a multi-member operating agreement is kind of sort of like the prenuptial agreement to a marriage. Okay. And the way that I'll often describe this is when I'm about to get married, I'm super happy. And I don't want to ever think that anything at all is going to go wrong with my wife. And so the thought of having a prenuptial agreement, it's like, why do I need a prenup? We're going to be together forever. We're going to die together, right? And then ultimately something happens to the marriage and we get a divorce. And at that point I go, boy, I wish I would have had a prenuptial agreement. It's the same thing here. Okay, the operating agreement is partly the agreement that's going to govern, and we need to enter into this agreement when everybody is happy-go-lucky and ready to go make $1 million. So that way, when things start to go south, when money gets involved, that's sort of like the key kicker of all of this. But once money gets involved, we already know how to handle it. It's already been decided. And hopefully, if we've done our job in the operating agreement, we don't now say, okay, wait, what are we supposed to do? This is too vague. We're not sure.
Yeah, I mean, I've been in rooms before where other gyms have partnerships. And one of the things, I mean, you're talking about pay, and that's obviously very important. But there's also the other thing that I would also say that you could, I don't know if something you would put in here legally, or if not, then you guys should definitely, if you have partnerships, you definitely draft this up on your own time, is who's going to do what? Because whenever there's a partnership, most of the times, one of the things that I see all the time is who's doing what. Everybody's doing the same thing and nobody's doing anything. You probably should delegate certain roles to each other. Okay, you're going to do the marketing. I'm going to do the sales. You're going to do, the client facing stuff, and I'm going to do the back end book stuff. Like, you have to have your structure of your corporation, who's doing what role and who's wearing what hat, ironed out. Again, I don't know if that's something that you would put down on paper initially, but just to have, I'm talking with a lawyer, but you guys should definitely have that as a side note, to how you guys are going to get paid as well. I just think that it's good business. And this way, if me and Matt were in a corporation together and we're both the sales people, well, now who's going to do the marketing? Who's going to do the back end client stuff, the operation stuff? So I think having that stuff ironed out will also make your jobs a lot clearer. I mean, it's just like having an employee almost. Like, the more clearer you make it for your partner and yourself, the more those lines won't get blurred, and the chances of you having a divorce, like we just talked about, are less likely.
Yeah, and to hit that last point, Anthony, you just nailed it right on the head, which is, I refer to that as setting the proper expectations up front. And that is the leading impetus of just about everything that we do at Gym Lawyers, is trying to figure out how we set expectations up in every sort of interaction that a gym owner can have, especially when there's money involved. Now, one of the difficulties with writing an operating agreement for any business owners, but particularly gym owners, is that these things are infinitely customizable. Okay, I mean, if you call me up and you say, just write me a general operating agreement, I'm going to send you back a document that's like 10 pages long, and almost everything within those 10 pages, except perhaps the first few introductory paragraphs or sections, everything else is customizable. So, the reason it's difficult with gym owners, and I don't mean this as, I'm a gym owner myself, so like, I'll make fun of us. We're not sophisticated business owners, and that's not a slight at anybody. We're just not. Like this. We just, a lot of us. I got into the gym business because my current gym was going out of business, and I wanted somewhere to make sure I had to work out every day after my legal practice. Right. That's why I started my gym, and so we start gyms because we want to train people. We don't start gyms because we're investing in multi-million-dollar companies trying to make money and run these big companies and corporations. We're all unsophisticated. So it's tough to have these long conversations with the gym owners about exit clauses and competition clauses and tax representative clauses and these things that we have to have in an operating agreement, because they're just it's nothing that we're ever concerned about. So to get to your point, yes, we could put roles and duties into an operating agreement. I've drafted some where we do that. If asked, my general suggestion, and this sort of goes along with kind of the getting out and exit clauses and things like that in an operating agreement, which we'll get into, but is putting those things through what are called a letter of resolution. Okay, and letter of resolutions exist both in corporations and in LLCs. And basically what that is, let's say that you and I, Anthony, are partners, and we want to make a decision in how to move forward with the company. We're going to come together, we're going to have this formal meeting, and then at the end of the meeting, we're going to write up a single page letter that basically says, on such and such date, owners, Matt and Anthony, came together and we discussed X. And at the end of that discussion, we decided on Y, and therefore we're going to move forward with Z. You and I each sign it, and we save it with essentially the operating agreement wherever our business records are. Okay, and that's how companies and corporations, and corporations sort of make decisions between the owners moving forward. Okay, so a lot of information here, but the point is, if we put something in the operating agreement, it's a pain to have to amend that multiple times. If we throw something in a letter of resolution, then that's an easy way to just come together, have a meeting, redraft a letter of resolution, sign it, we're moving on. And that's how I usually suggest that the multiple partners come together and to outline their day-to-day duties would be in a letter of resolution. And then set meeting times of once a quarter, once every 6 months, once a year, and they reevaluate those job descriptions because sometimes they change. And so we can then just adjust the job description, put it back in another letter of resolution, and we move on.
Yeah, that makes a lot of sense. I think one of the things too, I don't know if this is part of it, but I want to talk about pay a little bit too, because I would assume that that's probably a bigger portion of it. But so let's say you took somebody on, you had this idea to open up the gym. You're the personal trainer, gym owner. You want to start this gym. You have this grand vision. But you need capital. So you go and you get a partner. Now the partner puts up all the money and you put up what's known as sweat equity, where you basically work for, your cut of it, right? Now, the gym starts generating some profit. How do you guys pay yourself? Does the person who put all the money in get all the money first? How does that work? How does that usually get structured? Is that something that's important to have written out?
It's super important, and any and all of the above, Anthony. But typically there's going to be about three common ways that we suggest gym owners worry about getting paid. If you're bringing in a savvy investor, this is going to change, because if they're a savvy investor, they're going to have certain restrictions on how they make their money back, whether they're just equity partners or whether they're operating partners, whatever it is. But we'll worry about that on like the next episode, right? So the three sort of primary ways that a gym owner is typically going to get paid through their LLC. One is being paid as an employee. So as a corporation, Anthony, you are taxed, your corporation is taxed automatically as an S Corp. Okay. There are other tax designations. You could be a C Corp if you are a publicly traded corporation or something like that, but you're not. So you're just taxed as an S Corp. And usually what that means is the owners are paid as employees of the corporation. So you designate yourself to get a reasonable income every month or a reasonable salary, and the corporation just every month pays you that reasonable salary. Okay. And you can do the same thing. That's one of the flexibilities of an LLC, is you can do that same thing with an LLC. A multi-member or even a sole member LLC can designate themselves as, for tax purposes, sole proprietorships, partnerships, or S Corps. Okay, so one of the easiest ways is to just designate your LLC as an S Corp and pay yourself or in your partners as employees, getting reasonable salaries every month. Okay, now that's a conversation that you need to have if you're an LLC with your accountant, because I believe, don't quote me on it, I believe there's sort of like a revenue threshold where it becomes advantageous to file as an S Corp. I'm aware that there are accountants out there that believe that like from day one, you need to be an S Corp, and that's fine. That's their profession. I'm not going to step on their toes. My understanding is it sort of becomes more advantageous once you reach above a certain threshold of gross revenue. Anyway, that's number one. Number two, the second way to get yourself paid is what are called guaranteed payments. Okay, and these are very similar to paying yourself as an employee, right? It's just if you are going to move forward under a tax designation of a partnership, then you might want to pay yourselves, each partner might want to agree to pay themselves a sort of like a pseudo salary, right? And again, don't get too lost in the weeds here, but it's not a salary really. It's just a profit distribution that you're guaranteeing to yourselves each month. So we might say that regardless of the work that we do, we are going to guarantee ourselves $2,000 a month of a salary. Okay, air quotes there. So regardless of how much money, how much profit the company has, we just know that we get paid $2,000 flat rate each for whatever services we render on behalf of the company throughout the month. You could also do this hourly. It would be, I think, tedious to do it that way. But, I could say, Anthony, you're going to coach all the classes and we're going to agree to pay you $25 guaranteed payments per class. So you just keep track of your time. And at the end of the month, whatever profits, we'll just take whatever hourly rate times your number of hours out of those profits, and that's sort of like your guaranteed payment. Okay. Number three, in the simplest of all of these, is straight distribution of profits. Okay. And what that means is, okay, let's assume that you and I, Anthony, own this LLC together, and next month we have $10,000 in net profits. Okay, so net profits means we've got our gross revenue, we've taken off all of our expenses, and we're left over with, even after taking out taxes, okay, we are left with $10,000 left over. Okay, you and I then come together and we say, okay, we've got $10,000. We're just going to distribute that between the two of us. And we agree how. Are we going to take $5,000 each? Are we going to take $4,000 each? Are we going to leave some money in the business bank account? But it doesn't matter what we do throughout the month. We are just now agreeing to split whatever net profits are there through distributions in whatever way we come to an agreement on.
Yeah, and like you said, I could imagine once money gets involved, it gets like crazy. Because if there's $10,000 of profit and I'm the one doing all the training, well, I'm going to say, well, I'm servicing all the members, so that money's mine. So this is why it's so important to have this laid out. But Matt, I kind of want to back up a little bit because while you were talking, and I know you see so many different types of gym owners and people. So my question to you is, out of all the gym owners that you've worked with, I guess any business, right? Out of all the businesses that you've worked with, how many partnerships fail that you see? Because I could see where this is going here.
I plead the fifth on that answer.
Is it a lot?
Yes.
So now my second question to that is, what are the keys to having a successful partnership?
Setting these expectations up front.
Yeah, exactly. I would say, because like I said, just using that $10,000 example and like what you just said, like if I'm servicing all the members, well, yeah, well, that's my money.
Yeah.
If I'm selling them and I'm this and I'm that, that's where it gets like all those lines get crossed. But yeah, and it's just the same thing as having like a really good employee, being kind of like strict, like this is the line, this is your KPIs. Are you meeting them? Are you not meeting them? And just having that straight talk. And like you said, you equated it to a marriage before, but taking the emotions out of it and just strictly, okay, I'm in charge of X, I get X. I think it's just keeping it as cut and dry as that really makes a big difference. I could be wrong, but you've seen more than me, but.
No, you're exactly right. Majority of marriages fail, majority of partnerships fail. It's just how it works. And you and I both know, being in the gym industry, it's not always easy going. It's not. You don't start a gym business and all of a sudden next month you're making $10,000 of net profit. It just doesn't happen. And I'm sure we've both had, I know I've had discussions with my manager. I'm sure you've had discussions with your manager about, you just, as a gym owner, there are months where you work and work and work as much or more than your manager now works, or that you've worked, and you didn't make half the amount that you're now paying your manager to do it. And that's the nature of the business. And so these two people come together, they're best friends. They think, oh, we can crush it in a gym business. And they start out, and the first few months, they're really struggling. And somebody feels like they're doing all of the work. And now tensions start to build because they're not making money and they're having to put in a lot of work in order to make that money. And I'll give you another one that I talked about recently with a gym owner. Was he brought in an investor, and the investor was meant to just be what's called an equity investor, which means they don't have any influence on day-to-day operations. That would be, you kind of alluded to the example a couple of times, Anthony, but you're starting a gym, or you have a gym, and you want to bring me on in order to provide money, have an influx of cash that the gym can now operate off of. Well, if I'm a savvy investor, I'm going to come in and be like, well, sure, I'll give you this money. I want to get reimbursed first. And after that, I want whatever percentage. I want 33 and a third. I own 33 and a third percent of the business. I want 33 and a third percent on distribution of net profits in perpetuity. You don't know any better in the beginning, so you agree to this. Now, 5 years in, you're tired of giving me 33 and a third percent of net profits every month when I'm literally doing nothing. You are day-to-day operations, and you just keep having to shovel out a third of everything that you make. Every dollar that comes in, you lose 33 and a third percent to me. And that really starts to grind some gears after a few years. And then we have to have those uncomfortable conversations about, how do we force the investor out? Because oftentimes you can't do it.
Well, I kind of want to, based on what you just said, I wanted to move into like taxes, right? So if I was to invest in somebody's business and I wanted to be that person, right, and just sit back and just collect the chunk at the end, what about taxes? Is taxes different for different partners? How does that kind of work? And is that something that you would kind of structure in your partnership deal as well?
Uh, that's not something that I'm going to touch too much on. Um, the only thing that I really get involved on in an operating agreement is the initial designation of the LLC. If it's a corporation, it's pretty much defaulted designated as an S corp. If we're an LLC and it's multi-members like that, and even if we have investors, then those people just all have to talk to each other, go to accountants, and figure out, is the LLC going to be best taxed as a partnership or as an S corp? But generally speaking, any time you get a distribution, you're taxed as a self-employed individual on that distribution. And again, that's not a direct quote. If you had an accountant on here next show and he said I was completely wrong, I wouldn't lose a lick of sleep over it. But you, like, there's no way for me to control how that investor is taxed through the operating agreement. It's not like we can tax the LLC one way, but the owners get taxed a different way. It doesn't work like that. It's either the LLC is taxed as a partnership, and you're taxed as a sole individual, and all that money essentially passes through the LLC to you as an individual, or you're an S corp and you're paying yourselves as employees. Now, the investor may not take any employee or any employee salary and may be paid solely off of distribution, in which case they would likely just be taxed sort of on a self-employment of that gross amount of distribution that they receive. Does that make sense? I think I said a lot of big words in there, but
it does. Oh, it does, man. I get what you're saying. It does make sense. So let's talk about the thing that I know most people probably click this one for anyway. How do you get out of a bad partnership? So bad partnerships happen. How do you get out of that divorce? What do you do?
Sure. Yeah. Getting people out. All right. Once again, there's like a million ways to do this. And people may hear things of like put clauses and call clauses and shotgun clauses. And once again, I'm just going to say these are really advanced, complicated, high-end things, ways to get in and out of LLCs that 9 times out of 10, us unsophisticated gym owners don't need to worry about. Happy to talk about them. We don't really need to worry about them. So generally, when I'm talking with a gym owner, I'm going to say there's about 3 ways commonly to get out of an LLC. Okay, one is what's considered a simple buy-sell of how somebody voluntarily wants to leave. Okay, the second way is what's called a call clause. We just refer to it generally as an exit clause, and I'll kind of explain what that is in a second. And the third way is death. Okay, basically, if you die, you're out, and we need to designate what happens to your ownership interest in the LLC or your shares in the corporation if you die. Okay, so the trouble that we see when gym owners call us with these partnership problems is that they did not heed the advice that they're now receiving in this episode, which says, get this paperwork all done at the time that you set up your corporation. They didn't do that. And so now they're reaching out and they're saying, usually, how do I get my partner out of this LLC? Because I'm tired of paying him or her for doing nothing. And I then say, where's your operating agreement? And I usually get one of 2 answers. One is, we don't have one, which is a bigger problem than just now trying to get out of the LLC. Or 2, we have it, but we got it off of just some template service that was provided for us when they filed our LLC, and I don't really know what it says. Okay, which says to me, you're like, the only way that you can get out of this is if the other partner agrees. Okay, and that becomes a big problem. So we've got sort of our 3 ways of getting out. One is the easiest is if the partner voluntarily leaves. Okay, and that's just a simple, referred to as a buy-sell agreement. We throw it right into the operating agreement, and it would basically say, generally, Anthony, you want to leave my LLC, you have to give me notice. Within 30, 60, 90 days, I come back and I determine whether the LLC is going to buy back your shares or your interest, or whether the other owners are going to buy out your interest. And then we determine what the price is, generally set off of fair market value. And then we figure out sort of what the payment plan is. So if the fair market value of your interest is worth $50,000 and the LLC is going to buy back that your interest in the LLC, what kind of a payment plan? Does it get 60 monthly payments over the next 5 years? Is it 48 payments over the next 4 years? Is it quarterly payments for the next 8 years? This is you tell me how you want to do it and I'll put it in the operating agreement, because there's just so many ways to do this. So Anthony, any feedback on number one before I go into number two? I don't want to.
Well, yeah. I mean, what if you guys? Well, a couple things actually while you were talking. First and foremost, what if you don't have one in place? Now what? There's nothing you could do. You're kind of screwed unless the other person agrees to it.
Yeah, really, and unless they are doing something that's directly hurting the company. If they've entered into a contractual agreement that is now destroying the company, if they've defrauded you in some way, if they're stealing money from the company, if they're doing something illegal, generally the Uniform Limited Liability Company Act is going to say, and that's adopted by most states, but that's going to say that you can kick somebody out if they're doing something to damage the company. The trouble there is damaging the company in the legal realm is a very vague term. And that's what causes litigation. Is I think you're doing something to damage the company. You don't think you're doing anything that damages the company. The only way I can now push you out is to sue you to kick you out. And that's what litigation is created out of. And that's why we don't want to do that, because that's now super expensive.
This is like really murky waters that we're entering in right now, because I could see how muddy this could get. Because now if you're in that scenario right now and you can't get out, and then you're trying to approach the person, now who's to say the person doesn't turn around and just pull money out of the account and doesn't want to leave and really screw things up? I mean, I guess they could in any way. So this is why it's so important. And hopefully you're listening to this before you get into a partnership, because these are things that you have to consider. And again, having this stuff laid out initially is very, very important. Just setting those expectations up in writing, I think, is very, very important.
And if there's one thing you take from this episode, besides the fact that you need to do this, the other thing you need to take away from this episode is that this stuff happens in the gym industry. Perhaps I get a little bit egotistical and frustrated, I will admit, but it's a bit frustrating for me when a gym owner says, well, yeah, but we're just a small gym. This is never going to happen. Yeah, it does. Okay. And I know it happens because I'm the one who gets the phone call. But when a gym owner calls me up and says, my partner closed the business bank account, siphoned off all of the money, opened up their own personal bank account, and now I have no business to run, or I have no money to run the business. What do I do? I don't know. Like, go call a local attorney. You're gonna have to sue him. Like, there's only so much you can do in a scenario like this, and it happens, and it's very painful when it does happen. And now, granted, nothing in writing is going to prevent some of these things from happening, but if you're going to go after somebody like that, having something in writing only serves to strengthen your ability to, in the end, lessen the impact on you as much as possible.
So let's talk about like the successful partnerships. Like you said, they have all this stuff out in line. Is there anything that should be set up, I guess, on the back end to protect yourself from this happening? So again, me and you want to open up a gym. How do I protect myself against, I'm just going to say you or me or one of us stealing the money out of the account? Like, is there a way to protect ourselves prior to all of this? Because these are like some of the things that are flying through my mind right now.
Yeah. So you can, I mean, you could set up different controls in the bank account. Certain banks will allow you to say things like dual signatures in order to make withdrawals. So there's little things like that that you can use to protect yourselves. You can also take out insurance policies on individual members. The LLC can take out policies on members. The members can take out insurance policies in order to protect against stuff like this. Oftentimes, we'll see, if an LLC may take out an insurance policy on its members in the event that the member dies. They now essentially have a life insurance policy on that member to help buy back that membership interest from the dead member's estate. So there are insurance policies that you can take to try to protect yourselves against this. There are little things within bank accounts that you can take to try to protect yourselves against this. You can set voting rights within the LLC that require some sort of neutral third party breaker of ties on voting. But ultimately, it's like anything else, Anthony. Regardless of how much preparation we put forth, we're only going to stop 90% of all these things that could go wrong. You're never going to prevent anybody from suing you. You're never going to prevent anybody from stealing from your gym, stealing from your partnership, breaking something. You're never going to prevent it all. So what we're trying to do in order to run a successful partnership is to set up these expectations, put this stuff in writing as much as possible. So 90% of your bad thoughts are now chilled because we have it in writing, and you can't, as a good individual, you can't do it.
And what if there's multi-members? So more than just two. We're talking partnerships, so that's two people. But what about like multiple people? Anything different that has to happen when there's 3, 4, 5 partners?
Voting rights become more important. How we're going to figure out those votes become more important. In the realm of an LLC, we can now control who has voting rights. So we're getting a little bit further, but let's assume let's kind of set up this scenario a little bit where you and I are the operating partners of the LLC, but we're going to bring in other investors. Okay, and we're not going to give these investors. You and I kind of we split the majority. Maybe we split 30% each, so we own 60%, and then we bring in 4 investors and we give each of them 10%. Okay, we don't want them to have any voting power, because if the 4 of them vote together, they've got 40% voting power. Depending on how we structure everything else, that may give them a lot of power to make a decision that we don't want them to make. They're just investors. We're the operators. So what we can do at that point is we can redesignate the LLC as what's called a manager-managed LLC, as opposed to a member-managed LLC. And a manager-managed LLC allows you to appoint certain people in order to run the LLC specifically. And those are the people who really have the power to make the decisions, to make the decisions, to do the day-to-day operations, to designate how people are going to be paid, to draft the letters of resolution, those sorts of things, in order to really protect those 2 members who are the primary operators from people coming in who are just trying to invest to make some money on the back end.
Yeah, guys, and from what I'm hearing with all this, it sounds like every scenario is really based on what's going on with you and your goals. So if I were you guys and you're listening to this, you're either getting into a partnership, have a partnership, and want to get all this stuff cleared up, I would just head over to jimlawyers.com, contact Matt, get on the phone with him, and dial all this stuff in, because again, one of the best ways to make money and have extra profits is to protect yourself. And as you guys heard in this, it could be murky waters. And like you said, when you guys first get together with your partner and in a marriage, you're all happy and giddy. Nothing's going to happen. Nothing's going to happen. And then, like Matt said, money's usually the trigger that sets people off. And I mean, it's the same thing with your employees too. If your employees start to, see the gross number of what the business makes, and they're like, oh my God, my boss is rich. And, and then they start taking advantage and they steal the toilet paper and all this other stuff. It's like, that's the same thing that happens with a partnership as well. So I would just contact Matt, get in touch with him, have him go over this stuff with you, and just protect yourselves, because that's the only way you're going to really, really end up with more profit. And I guess it's always better to be safe than sorry. I mean, that's the way I always look at it. One of my favorite things to say all the time is, as long as I can rest my pillow on my head on my pillow at night, knowing that I did everything right, I'm okay with my life. So as long as I'm protected, my partnership is protected, and I know that I'm protected against anything that could possibly happen. If God forbid something would happen and I have to get out, or my partner has to get out, there's rules in place to get out. And that's just the way it goes. That's the way I look at it. I don't have a partnership, so I can't talk about it. But from what I'm hearing from Matt, I think I'm basically summarizing what he said.
Yeah, the nice thing about employees is you can fire them pretty much at will. Much harder to do that in an LLC unless you have an exit clause put in place and parameters around that allow you to kick somebody out for essentially not doing anything, is usually what we end up coming down to.
Yeah. And so Matt, so just want to structure, so somebody listening to this brand new, they want to start a partnership with somebody. First thing, what are like the top 3 agreements they would come to you and need?
Starting
Or
a
4,
partnership,
5,
just starting a
5, whatever,
partnership,
however many there are.
or
Yeah.
just starting a gym, period.
No, starting a gym with a partner.
Okay. So the first thing you got to do is file the LLC or the corporation. Okay, that's like number one. As soon as the two of you, or 2, 3, 4, whatever it is, as soon as you all come together and you're like, green light, this is happening, then you got to do the LLC, okay, or the corporation. You got to have that state filing. Then from there, open up a business bank account and start putting some money in the business bank account. Called the capital contribution. That's the upfront money that everybody comes to the table with in order to kind of get the business started, cover expenses, buy equipment, et cetera, et cetera. Then you need to figure out whether or not your state requires what's called a fictitious name filing. I don't remember, Anthony, if we covered that like long ago on one of our first episodes.
So you could kind of touch it quick if you want.
Okay, so really quickly, a fictitious name is basically whatever name you're operating your gym as or your business that's different from your LLC or your corporate designation. I'll use my gym because it's an easy, clear example. My gym is Bionic Fitness LLC, but we do business as, some people know it as doing business as, Industrial Athletics. So the Commonwealth of Pennsylvania then says, if I'm going to do that, that's fine. I just have to file Industrial Athletics as the fictitious name for Bionic Fitness LLC. Right? A lot of gym owners miss this step. And there, again, we could do an entire episode on why that now leaves you legally exposed if you don't file it and your state requires you, or sometimes your local county requires you to do so. Okay. But that's sort of like number 3. So we've got the corporate filing, the business bank account, the filing of the DBA, and your state could call it a fictitious name, an assumed name, a trade name, a service name. There's all kinds of different names for it, right? And then sort of the last thing is the operating agreement or those bylaws for the corporation. And that sort of squares everything up so that we actually have an entity that's set to do its job, which is protect the owner's personal assets, and now be able to move forward with doing things on behalf of the company, like entering into lease agreements, taking on insurance policies, drafting legal contracts that the clients to the gym are now going to come in and sign, provide services, take on investors, take on debt, whatever it is.
Yeah, and there you go, guys. So, and if you are an existing partnership, I would definitely still give Matt a call and have him
No
just
time
run
like the
through and just
present.
check. Yeah.
Yep.
So, and just out of curiosity, I know we're kind of out of time here, but just out of curiosity, so let's say somebody's listening to this who has a partner right now, but they're on good terms, everything is good, and they're like a little bit afraid to like, oh, if I tell him I'm talking to a lawyer, or him or her, that I'm talking to a lawyer about an exit clause, maybe he'll panic and think I want to leave. So what would be a good way to like approach your partner to kind of say like, hey, I want to set this up?
Yeah. So you should at least have a good enough relationship with your partner, hopefully, if you're on good terms, to say, hey, I just listened to this episode on the gym profit multiplier, and I really think we should talk with an attorney, whether it's me or not. We should talk to an attorney just to make sure that everything that we have in our agreement, our operating agreement, or our bylaws is sort of buttoned up and protecting us, because it's not always about one partner trying to get out against the other partner. That they work both ways. So once you can get the partner on the phone, I'm gonna, if I have one partner reach out to me and they want to talk about this, that's fine. I'll talk to them about it, but ultimately we need to reschedule a call to get all partners on the phone, because I'm going to explain the potential pitfalls of not having one of these agreements put in place and how it can impact both parties. Because again, I may be secretly looking to kick you out, Anthony, but by looking into a partnership agreement and signing it, I'm also agreeing to the fact that you can kick me out. Okay, so it works both ways. It benefits both sides. And we need to have a conversation with all the partners about how you are protecting yourself as a partner and your personal assets by redoing this stuff, by redoing these agreements, and having a little bit more influence on what actually goes into the agreements.
Yeah, and Matt, if somebody is interested in reaching out to you, how do they reach out to you? Where do they go?
Yeah, the best way is just gymlawyers.com. Gym Lawyers is like a gymnasium, GYMLAWYERS, gymlawyers.com. I've got calls to action all over the website. My cell phone's on the website, my email's on the website, and however your preferred way is to reach out, doesn't matter to me.
It's so funny because that's actually true. So the first time I reached out to Matt, it was like a cell phone. I'm like, this guy's a lawyer. He gave me his cell phone number. I'm like, he's probably charging me on the side for it. Me and Matt have become good friends over this whole time since I've used him initially. Guys, I highly recommend checking Matt out and just going to him and just making sure that your I's are dotted and your T's are crossed. It's always good to have a friendly lawyer. And as you guys can see here, he's got medicine on his shelf over there. For those of you who see, there's a medicine book on the shelf. There's a personal training book right there. So Matt's a great guy, guys. I highly recommend checking him out. And again, even if you don't use his services, just get on his email list. He sends out really good stuff. You actually sent something out the other day with partnerships. It was just funny, kind of odd coincidence there. But yeah, guys, just get on his email list. You can learn a lot of stuff from that too. So guys, if you guys want help in any of this stuff, just make sure you click the links below. And until next time, this was Anthony and Matt, Fitness Profit Multiplier and Gym Lawyers, and we're signing off. Bye, Matt.